Business finance is often considered boring because it focuses on budgets, taxes, expenses, records, and planning instead of exciting ideas, marketing campaigns, or rapid growth strategies. In this video, we are sharing 7 boring business finance tips to learn before starting a business. Number 1. Negotiate supplier payment terms. Negotiating supplier payment terms may sound boring, but it can have a major impact on your business finances. Many new business owners accept the first terms offered without realizing they have room to negotiate. Better payment terms help preserve cash and reduce financial pressure during the early stages of growth. For example, receiving 30 or 45 days to pay an invoice instead of paying immediately gives your business extra time to generate sales before cash leaves the bank account. You can also negotiate discounts for early payments or larger orders when your business becomes more established. Building strong relationships with suppliers often leads to more flexibility during difficult periods. Healthy supplier relationships improve cash flow, increase stability, and allow you to manage unexpected challenges with greater confidence. A simple conversation about payment terms today can help prevent financial stress and improve your business operations for years to come. Number 2. Understand tax obligations before launching. Taxes are not exciting, but ignoring them can become one of the most expensive mistakes a business owner makes. Before launching your business, spend time understanding the taxes that apply to your industry and location. This includes income taxes, sales taxes, payroll taxes, and any permits or licenses required to operate legally. Many entrepreneurs focus entirely on generating revenue and forget that a portion of that money may already belong to the government. Without proper planning, tax bills can create serious cash flow problems. Consider opening a separate savings account specifically for tax payments, so the money is available when deadlines arrive. Learning basic tax rules also helps you avoid penalties, interest charges, and unnecessary stress. A business that starts with good tax habits is usually better prepared for long-term growth, stronger financial management, and smoother operations as revenue begins to increase. Number 3. Set aside money for maintenance costs. Every business eventually faces maintenance expenses, even if everything appears to be running perfectly today. Equipment wears out, computers become outdated, software requires upgrades, and facilities need repairs. Many new business owners underestimate these costs because they focus only on startup expenses. Creating a maintenance reserve fund helps you prepare for these unavoidable situations before they become emergencies. Even small monthly contributions can make a significant difference over time. Imagine having to replace important equipment unexpectedly while your business is already managing payroll, rent, and inventory expenses. Without a maintenance budget, you may need to rely on loans or credit cards to solve the problem. Planning ahead keeps operations running smoothly and reduces financial surprises. Businesses that prepare for maintenance costs are often more stable, more resilient, and better positioned to continue serving customers without interruptions during challenging periods. Number 4. Focus on profitability before growth. Growth attracts attention, but profitability keeps businesses alive. Many entrepreneurs become excited about expanding quickly, hiring more employees, or opening additional locations before proving that their business model generates healthy profits. Revenue growth looks impressive, but higher sales do not automatically mean higher earnings. If expenses increase faster than income, the business may actually become weaker over time. Before investing heavily in expansion, make sure your products or services consistently produce profits. Study your margins, monitor operating expenses, and identify which activities contribute the most value. Profitable businesses have more flexibility, stronger cash reserves, and greater ability to survive economic downturns. Sustainable growth comes from a solid financial foundation, not from chasing bigger numbers. Building a profitable business first creates confidence, supports future expansion, and allows owners to make smarter decisions without constantly worrying about cash shortages. Number 5. Maintain organized financial records. Keeping organized financial records may not seem exciting, but it saves business owners countless hours, reduces stress, and improves decision-making. Accurate records help you understand where money is coming from, where it is being spent, and whether the business is moving in the right direction. Organized records also simplify tax preparation, loan applications, and conversations with accountants or investors. Waiting until the end of the year to sort through receipts and invoices often creates confusion and increases the risk of mistakes. Develop a simple system for storing invoices, bank statements, receipts, contracts, and financial reports from the beginning. Digital tools make this process easier than ever and help maintain consistency. Businesses with organized records can identify trends, solve problems faster, and make informed decisions based on real financial information rather than assumptions or guesses. Number 6. Plan capital expenditures wisely. Capital expenditures refer to significant purchases that provide long-term value to a business, such as machinery, vehicles, technology systems, or office improvements. These investments can support growth, but they also require careful planning. Many entrepreneurs purchase expensive assets too early because they believe more equipment automatically leads to greater success. Before making a large purchase, ask whether the investment directly improves efficiency, increases revenue potential, or reduces costs over time. Consider leasing options, financing alternatives, and the expected return on investment. Large expenditures can reduce available cash and limit flexibility if they are not planned properly. Creating a spending plan helps prioritize essential investments while avoiding unnecessary expenses. Businesses that approach capital expenditures strategically are often more financially stable and better prepared to adapt when market conditions change. Smart investment decisions today can strengthen your business for many years ahead. Number 7. Track every expense from day one. Tracking every expense from the first day of operation is one of the simplest yet most powerful habits a business owner can develop. Small purchases often seem insignificant, but over time they can add up and affect profitability. Coffee meetings, subscriptions, office supplies, software tools, and travel expenses all contribute to the overall cost of running a business. Without proper tracking, it becomes difficult to understand where money is going or identify opportunities to reduce spending. Recording expenses regularly also improves budgeting accuracy and supports better financial planning. Many business owners discover hidden costs only after reviewing their financial statements months later. Developing this habit early creates awareness and encourages smarter decision-making. Businesses that monitor expenses consistently tend to have better cash flow, stronger financial discipline, and greater control over their long-term success. Even a few minutes of tracking each day can lead to better financial outcomes. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.